Hi, I'm Pattu from freefincal. Let's take a look at Axis Quant Fund, which is currently in its NFO period. Now, a quant fund will use a mathematical model to either determine the stocks or bonds in the portfolio, or to determine the asset allocation. Dynamic asset allocation funds or balanced advantage funds use a quant model partially to or fully to determine the asset allocation, whereas a quant fund typically is one that uses a mathematical model to determine the actual portfolio itself. I have talked about quantitative mutual funds before, whether it makes any sense to invest in them. I have reviewed the DSP Quant Fund. I had reviewed Quanta Quant Fund. They all thought there's a lot of hocus pocus like nanoparticles, artificial intelligence, and so on. This one claims that there's no that kind of fluff, thankfully, in this fund, in the Axis Quant Fund, but this claims that it will have better risk-adjusted robust performance, better performance across market cycles, best robust investment process, and so on. The point is, Axis has got a lot of diversified, actively managed funds like Axis Long-Term Equity, Axis Blue Chip, Axis Midcap. If they are claiming that this is going to, this quant model is going to offer better risk-adjusted performance, then what about them? This is the problem with the AMCs launching NFO after NFO after NFO. They will say that this is the best, and then when they talk about that fund, they will say that is the best, and so on. There's no real. I don't know. I don't have anything good to say about it. See, there are many factor indices. I talked about low volatility indices. You may have seen it in my stock portfolio itself, in my monthly stock portfolio updates. There are many other multiple factor indices and so on. I'm not saying they are better, but at the very least, there will be some clarity on what the index is all about and how the stocks are being selected. What is the model used for that? In this case, what happens is, when they say quant fund, it is not a purely quant fund. They will say they will mix qualitative and quantitative factors in the stock selection, and that just means it's a complete black box. Now, AMCs are reluctant to introduce factor-based index funds. They want to introduce only them as ETFs. Then they will say there's a fund of fund and so on. I don't know. It's completely baffling. But they prefer. It's just a matter of profit, I suppose. They prefer to have actively managed quant funds, and therefore they can charge more for this, assuming that they will do better, of course. Like I said, so it's a mixture of qualitative and quantitative parameters. And what is most amusing is, if you look at the scheme document, and if you it says the fund will follow a fundamental factor-based approach, and they say that the indicative list is return on equity, sales growth, cash flow, debt to equity. Now, just because you are using these numbers doesn't mean you are running a quant fund. Any normal fund manager managing a portfolio, or even a personal portfolio or a diversified equity fund, will be using factors like return on equity, sales growth, dividend yield, earnings yield, and so on. Just because you are using them numbers doesn't mean you are running a quant fund. This is I don't know what to call this. So they say they will have some risk criteria based on liquidity, stock price, volatility, momentum, and so on. So they have just added everything and said this is an indicative list. You take everything and put it into a bag and say, I will choose whatever I want from that. This kind of I don't know how you how to place the faith in such offerings. So they will have a quality score, and they will have a risk score, and they will determine the weight based on these two scores. The quality score is based on dividends, earnings yield, blah blah blah. I just told you about. Now they show this as the drawdown, and they say, look, this is the black is the BSE 200, the burgundy is the portfolio, and they say the portfolio has fallen less and it has moved up more better. It has recovered faster. The point is that even an equal weight index has recovered faster than Nifty. You can see that today. You don't know whether it is because of the model or whether it is just because of the way the market has behaved. We have been talking about a market disparity from late 2017 onwards until the market crash, and that the market crash completely dissolved that market disparity, and all segments of the market started moving up. So nobody knows whether it is purely chance or whether it is because of this model. So it's just what I mean. These things, there's really nothing compelling to for investors to even keep it on a watch list. See, okay, people will say NFO, don't buy, but at least you can keep it on a watch list. Even for that, I don't think this fund warrants any attention.